Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. We kick off this week with Naspers and Prosus, and I was never shy in being critical of the previous management team there. Bob van Dijk made an absolutely ridiculous amount of money as the CEO of Prosus and Naspers, despite poor performance and obvious reliance on Tencent as the gem in the group. A legacy investment that had nothing to do with his abilities. After Van Dijk was pushed out in September 2023, there were many questions around who might replace him. Chief Investment Officer Erwin Tu took over the interim CEO role, and that news didn't do much to impress the market because Tu was right there alongside Van Dijk in all of the capital allocation decisions that irritated the market. Fast forward to today, and there's a new name on the table, a very Italian name, with Fabrizio Bluisi appointed as the CEO. I listened to the almost hour-long call to introduce him to the market, and I'm impressed. And it sounded like the analysts were impressed as well. It started off with Koos Becker explaining that with only 3 chief executives in the history of Naspers, a mistake is an expensive mistake. Now, he stopped short of saying that Van Dijk was a mistake, but you really don't need much imagination to hear the truth behind what he was saying. He then explained their process to get to Bluisi, in which they worked through a shortlist of 60 candidates and whittled it down to 12 after a process of 6 months. Interestingly, one of the major metrics they used was engineering ability and understanding how technology can drive solutions. Clearly, they were looking for someone who would roll up their sleeves rather than someone who took an ivory towers approach. Erwin Tu moves into a role called President and Chief Investment Officer, and he's probably slightly lucky here to still be with the company. His former role, as mentioned, was CIO, so this earned a question on the call for him about what the difference really is going forward. Basically, he now has a slightly wider role, but he will still be the voice in the room that talks to capital allocation. The difference here is that the new CEO is an entrepreneur and operator of businesses, rather than another capital allocator. So the room is perhaps far more balanced, and hopefully the mistakes that Erwin Tu has seen and been part of before can be learned from. This is important because although half the cash on the Prosus balance sheet needs to stay there for the investment grade rating to be maintained, the other half needs to be used properly, and that is where they've fallen short recently. Bluisi could well be the difference here. He acquired iFood in Brazil in 2013 when there were 20 people working there. And today it has 5,000 people, so a great scale story within that broader Naspers Prosus stable. He speaks of being a passionate entrepreneur, but also someone who can recognize when something isn't working and is willing to pull the plug. The Prosus portfolio is a bloated thing with many, many businesses across classifieds, payments and fintech, edtech, and Prosus Ventures. The spray and pray approach of previous management will need to be far more disciplined now, but that's the right thing, particularly in an environment of higher interest rates. The market is not really interested in marginal deals anymore. They want to see optimization and discipline. And my gut feeling on Bluisi is positive, although goodness knows it's going to take him a while to actually get to grips with just how vast this portfolio is. Keep an eye on Naspers and Prosus. It's amazing how well a new broom really can sweep clean. Let's get into the good news that came out of South Africa in the past week. Afrimat has got to be on that list, with numbers released for the year ended February 2024 that do the track record proud. Revenue increased 23.9% and HEPS was up 24%. So that's a lovely outcome in terms of translating revenue into profits. And of course, just the extent of growth overall is impressive. Now they need to focus on the Lafarge acquisition going forward, and they do have the balance sheet strength to do it. There are some headaches, like the need to improve performance in industrial minerals, but the important thing here is that bulk commodities and construction materials are both doing well, and that is very much the core of the group. It is certainly worth covering Southern Sun as well, which released a trading statement that talks to a record year of profitability, music to the ears of shareholders, of course. EBITDA, with an R on the end as an industry standard metric for hotels, increased between 31 and 34%. Now, at a quick glance, it would then be quite odd to see that HEPS was only up 5 to 9%. You need to read carefully to find the adjusted HEPS number, which was up 87 to 90%. And this is the right metric to focus on, because it adjusts for the once-off payment from Tsogo Sun in the base period. It is very impressive to see that Southern Sun's share price is well above pre-pandemic levels, especially when you consider what COVID did to the hospitality industry. As a third positive local story, I'll talk to double-digit growth at Sanlam for the first quarter of the new financial year. They've managed a 14% increase in the net result from financial services and a 16% increase in net operational earnings. This was despite a 7% drop in investment management new business volumes. Now, speaking of investments, Sanlam does warn against assuming that the full-year growth rate in earnings will be in line with this quarter, because there was a strong investment return element to these numbers. And of course, you have to be very careful extrapolating something like that. But what is important at Sanlam is that they are clearly on a strong footing here, with the 6.5 billion rand Assupol acquisition set to further strengthen their position in South Africa, especially in mass market business. We now move on to property, and Nepi Rockcastle is just such a good example of how a property fund can ride the wave of an economy that is doing well. Poland's inflation rate has dropped and GDP growth has moved higher. The unemployment rate, well, that's close to historical lows. Wage growth, that's looking very strong, and that of course supports consumer spending. These are strong conditions, in fact, one might say perfect conditions, for a retail-focused property fund like Nepi Rockcastle, demonstrated by a 12.7% increase in net operating income in the first quarter of 2024. The like-for-like growth, that was 9.4%, and that's really good, driven by tenant sales up 10.5%. And if the tenants are making money, so is the owner of them all. Not only are turnover-linked rentals wonderful in that situation, but occupancies are low, and reversions, the rate on the new lease versus the outgoing lease, tend to be positive. With basket size up 8.8% despite the dip in inflation in Poland, consumers in the region are spending. But despite all of this, Nepi Rockcastle has given conservative guidance for distributable earnings per share, with a growth expectation of only 4%. Now, the share price, that has made it back to pre-COVID levels, which is a lot more than many other property funds can say. For example, Growthpoint is still languishing at levels 50% below pre-pandemic numbers. Now, in both cases, this obviously ignores dividends, which are a huge component of property returns. But the point here is that you just cannot invest in property funds without an appreciation of the economies in which they are operating, and you then need to marry that to the valuation on that fund. And we are still seeing considerable pressure in local property funds. For example, Dupula Income Fund's interim dividend is down 5%, as distributable earnings were hit by property expense growth and more shares in issue after the dividend reinvestment program. Over at Octodec, revenue grew 4.7%, but distributable earnings per share fell 6.4%. Despite this, the distribution was kept steady at 60 cents, which is really just a function of a payout ratio that has headroom. In such a case, even if earnings drop a small amount, the dividend can be kept stable because the payout ratio simply increases. But of course, you absolutely cannot keep doing that into infinity. At some point, you need your distributable income to grow, otherwise your dividend is certainly not going to grow. A couple of weeks ago in the first ever episode of Supernatural Stocks, I gave an in-depth view on why I'm bearish on MTN. The share price was just below 94 Rand at the time, and the market seemed to be ignoring the tough news coming out of MTN Nigeria in particular. Finally, the share price seemed to take notice when the group numbers came out, despite that pressure having been so well telegraphed to the market through the release of MTN's subsidiary results in Africa. MTN is now trading barely above 86 Rand at time of recording, so it's down nearly 10% from when I first covered MTN on this podcast. And there wasn't really anything new to cause this drop. It was just a case of the market actually waking up to the reality of what MTN is facing in Africa. This is something I'm going to take note of for next time MTN releases results, because it seems that the share price really only moves when the group numbers come out. People are not spending enough time reading about the subsidiaries. Also keep an eye on Vodacom, where similar forex challenges are playing out. In that case, it's more about the Egyptian pound rather than the naira in Nigeria. The principle is the same though, with Vodacom chasing growth in riskier markets and of course the problems that can bring. Vodacom's dividend for the year ended March is down 11.9%, but the share price is only down 10% this year, whereas MTN has taken a knock of over 25%. Either way, for all the reasons why I'm bearish on MTN, I am also quite bearish on Vodacom. I just don't see the appeal of telcos at these sort of valuations. They are really, really struggling, and the glory days of making a fortune from cell phone contracts and everything else are firmly over. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in Supernatural Stocks should be taken as advice.